you doing today? It's a good day to be alive, right? Yeah, it's a good day to be alive. Here we are all together. We're having caffeine. We're having some Cheerios. Some of us are back here stretching out, getting those muscles moving. It's good. I like being with you guys. I like being in the classroom with you guys, so I'm grateful to get to be here with you today. Now, guys, we're going to be finishing or coming close to finishing chapter 16 on the whole world of finance, the truncated, small world of finance. It's a much bigger world than I'm presenting in this class. We're going to, today, guys, make some time in class for you to gather into your groups to decide what stocks you're watching for the month. Yes, I know we're halfway through October, and that's okay. That's why we have things like historical data, so don't fear that stuff. By the end of class today, I'm going to be asking you to email me and all your group members your 3 to 4 stock picks. So they have to be traded on an American exchange, and you guys can do no fewer than 3, no more than 4. Now, the rate of return, guys, I've decided because of wanting to get through this chapter today, I'm going to cover the rate of return again on Friday during our online session. I'm not going to do that during class today. I did send a few of you a reminder. If you have not yet completed your handshake profile, please do so. I'll send another reminder with some additional instructions as well. It's an easy 10 points, and it's going to help you find a job. After we get through chapter 16, we're going to go back, actually, to chapter 4. I'm going to talk about forms of business ownership. People have been asking me about things like sole proprietorships versus corporations. We're going to cover all of that stuff. So bear with me, guys. But we left off, let's see if I can get my slides working here. We left off with the following teams, and I think I got everybody on here. So we're going to be gathering into those teams at a certain point today. All right, guys, I know we do a lot of review in this section because it can be a little confusing. If I am borrowing money to be able to finance my business, am I issuing stock or issuing a bond? I'm issuing a, say it real loud. It's a bond. Bond with a B. I'm going to sit back here for a minute and see what this experience is like back here. Back here with the brothers. Guys, let's talk about this for a second. What's a disadvantage? Can you tell me one disadvantage of financing your business using stocks? What's a disadvantage? Who can help me out? What's the disadvantage of using stock? Yes, ma'am. Yeah, they can. The board has some say in all this stuff. Well, what's an advantage of stock over bonds? Yeah, so what's an advantage of stocks over bonds? What might be an advantage? Yeah, you're not taking on debt, right? Do we have to pay dividends? Exactly right. All right. What's an advantage of a bond over a stock? They are more secure, and they have to be paid back over time with percentage. Begins with an I. You borrow them, you pay interest. So that's exactly one of the advantages of bonds is we maintain control. By the way, what I just did there, that's called breaking the fourth wall. Who likes the Deadpool movies? I love the Deadpool movies because he talks to the audience sometimes. Comes right out in it. But guys, bond ratings are based on how solid our company is. If you have a financially sound company and you're borrowing money, are you going to pay a higher or lower interest rate? You got a financially sound company and you're borrowing money, will you get a good or poor interest rate? You get a good interest rate. You're a good risk. And so we start looking at bond ratings. Now, we're going to look at this from the perspective of the company, and we're going to look at this from the perspective of you, the investor. There's two big companies, Moody's and Standard & Poor's. These are bond rating agencies. They basically come in, if a company wants to borrow money, they want to issue a bond, they evaluate the company's finances to say, is this a good risk or not? If you have AAA rated bonds in Moody's or Standard & Poor's, that's prime quality. That means if you're the company, you're able to borrow money at a lower rate. Anytime we get down to BA or BB, depending if you look at Moody's or Standard & Poor's, those are what we call junk bonds. Here's what that means, guys. For the company, they're going to pay a higher interest rate on the money they're borrowing. For you, the investor, if the company is paying a higher interest rate, could that potentially be a good or a bad thing for you? You're the investor. So I'm the company, I'm paying you back. If you're charging a higher interest rate, is that good or bad for you? It's good, because here's the reason. I just borrowed money from you guys, and I'm a poor risk. I'm down here in junk bond BABB territory. That means when I pay you guys back, I have to pay you higher amounts of interest. That's good for you guys. Is there a bad side to lending money to somebody who's a risky investment? Yeah, I'll put Maxwell on the spot here. Let's say, for example, I need to borrow $10 from you. Like the first time, if I ask you for $10, would you lend me $10? Yeah, because seem like a good risk. How about the third time that I never paid you back for the first 2 times I borrowed $10? He's going to tell me to go pound sand. He's like, Tonkin is not only a bad instructor, he's a deadbeat as well. This guy doesn't pay his money back. That makes me a higher risk. That means, for example, when John's going to lend me money, he's seen what Maxwell's been through, and you're going to charge a higher interest rate, aren't you? Yeah, he's going to charge me 20%, where Maxwell was giving it to me at 2 or 3 because he trusted me. So that's how investors make money. Here's the risk. If you're investing in junk bonds, if the people who are borrowing the money don't pay it back, you can lose everything and make nothing. So if you take more risk, you can have more reward, but it comes with risk. Does that make sense, guys? All right, it's important that you understand how this works. Again, if I'm a company and I borrow money, you guys as the investors can't tell me how to spend it. You can tell me you want your money back. That's the difference between stocks and bonds. So then we get into hybrids. Guys, can you buy partial shares of stock? No, you can't. Not pure stock. You cannot buy partial shares of stock. That's why these things exist. Let's talk about this for a minute. I know this seems a little dry, but I'm going to be using the analogy of sausage. Who here likes hot sausage? Man, I love hot sausage. Where do you get the best hot sausage? Waffle House. Oh, I like it. Waffle House, man. And probably at 3 or 4 in the morning, everything's good at Waffle House. Man, who here has ever been to a Waffle House? I love Waffle House. I go there anytime. I don't care how much it destroys my veins and my cholesterol. I love going to Waffle House. Well, we're going to be talking about how we get sausage out of money. Here's how it goes, guys, and trust me, I'm going somewhere with this. Not many of us are expert investors. There are people in this class who've made some bank in the markets, but not many of us are experts. If you want to give money to somebody else to invest for you, you can invest in what's called a mutual fund. That means I'm giving money to somebody else to play in the markets for me, and they're pulling money from a bunch of different people and investing in the market. So technically, when you do this, you could end up having a little bit of this stock, a little bit of that stock. But those investors are buying whole stocks. You're giving them money. They're paying you back a percentage of what you invest. That's very common in retirements. Guys, how many of you have ever heard your parents talk about their retirement? Yeah, because we all put money in. Here's the way the world works, guys. Most people don't get pensions from their companies anymore. We get things called 401ks. And that means every time I get paid, my employer takes a percentage out of my paycheck and invests it in a mutual fund for me. Now, I get to pick how some of those investments happen, but I'm not playing the market on my own. This company is playing with my money. I happen to be with Tia Kref. This company's been around since the 1800s. You might have New York Life. You might have any other company. But that's a mutual fund. So that means you're giving your money to somebody else to say, invest this for me, make my money grow. Here's where we get to the scenario where you can buy partial shares of stock. It's something called an ETF, an exchange-traded fund. Guys, some of you are putting your money in your stock portfolios into multiple places. What do we call that strategy? It begins with a D. Diversity. So you might say, for example, you're going to put some of your money into Lockheed Martin. Let's see if I can get a pen that works here. You're going to put some of yours into Lockheed Martin, which is a big defense company. That's a blue chip stock. Maybe you're going to put some into the tech sector. You're going to put some into Amazon, also arguably a blue chip stock. Well, you got a couple of companies that are big pharmacy companies that might have a COVID vaccine, and they're a little riskier, and maybe you even have some other tech startups. These are all places you can put your money. Well, if we run an exchange-traded fund, what we do, we invest in all of these, and we combine them into delicious, sizzling, hot, fresh financial sausage. Because sausage is when you take several kinds of meat and you grind it together. You repackage it, and it's sausage. Well, you can buy an ETF, you can buy a share of an ETF fund. So technically, you're getting stock that's made out of other stocks. Does that make sense, guys? By doing this, I mean, let's be honest, not all cuts of meat are created equal to go into a sausage. We don't want to go into the details of that stuff, but there's going to be good cuts and bad cuts going in here. You can buy the whole thing. And then you get into the futures market. I won't call on you, but how many of you have ever heard of the futures market? Oh, we got to talk about that thing, guys. Right now, today, the 14th of October, 2020, what's a gallon of gas cost in Pennsylvania? About $2.56. Well, somebody look up the price of a gallon of gas in 2009. Those are good times.
It's regular gasoline. You mean in Pennsylvania? The national average is 185.
Yep, was that in 2009? Yep. So the price of gas has gradually gone up. There were times between 2009 and now where gas actually in Pennsylvania topped out around $4.25 a gallon. Could you imagine if you're driving a pickup during those gas prices? It went over $5 in California. So if you were in the futures market and you were predicting that the price would go up, you basically are investing, you're buying low and selling high. That's the futures market. If you are basically investing in the market, if you predict that the market is going to go down, you make an obligation to buy more in the future. So I'm saying I'm predicting. This is an example, not necessarily the truth. If I predicted that 5 months from now the price of gas is going to go back down to $1.85 from $2.56 where we're at right now, and I make an obligation to buy and buy those shares of it, I can potentially get a nice chunk of the energy market at a low price. Well, here's the other trick though. If the price of gas goes up, let's say it goes up to $3.50, and I've already committed to buy it, I've just lost money on the deal. That's the futures market. It's very tricky to play, but you can make a lot of money within it. So mutual funds, giving your money to somebody else. ETFs, financial sausage. Futures is investing in the idea that the funding is going, the price is going to go down. You're going to make some money as you go. So, where does trading actually occur? How many of you guys, I've asked this question before, I'm going to ask you again. How many of you are actually playing with a little money in the markets right now? If I can ask you, what do you use?
Robinhood.
So we have Robinhood. What do you use? So your dad's doing. Okay. So but Robinhood and E-Trade.
Meditrade, I think it's called, or MT4.
Okay. Who else has their hands up? What do you use? Robinhood. Yep. SCS. I'm not familiar. Is that an app or is it a website?
It's a company. Yeah. So they kind of it's like the mutual funds. So they're handling my money and different investments.
You're a freshman in college. You got a mutual fund. If I could shake your hand with COVID, I would. Yes. Robinhood. Who else? E-Trade. Awesome. Guys, so it's an abstract concept in 2020 because the old days where we would see people running across the trading floor with big hands and ticker tapes saying, sell, 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 or buy, 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 that no longer exists for most people. Those guys are going the way of the dinosaur. So those are really not the same as they used to be. Now, we still have brokers. For example, in addition to using things like Robinhood, I use one of my banks, which is Chase, to do my trades. So I'm doing those through a broker. So I'm buying things off the secondary market. You can, if you are a broker yourself, buy off the exchanges directly. The people you see in movies like The Wolf of Wall Street running across the floor are traders. Those are people who can go in and actually do trades on the exchange. They are brokers. They're doing that themselves. When you are using an online intermediary, whether you're using E-Trade, whether you're using Robinhood, whether you're using Chase, you're essentially using an electronic broker to buy your stocks because you guys are not brokers. If you were brokers yourselves, you could buy and trade. Guys, in terms of the dealer markets themselves, most of what we're doing these days is going electronic. And so if you want to know who the first and biggest one was, it was the NASDAQ. I never remember what this acronym is, but what it is. It's the National Association of Securities Dealers Automated Quotation System, the NASDAQ. And what this came out in the 1980s, before the internet was publicly accessible, it was electronic trading over telephone lines. And the trick is They're also publicly traded. You can buy shares in the actual NASDAQ. Who here has seen The Wolf of Wall Street? When we had people calling people up over the phone to do stock trades, those are stocks that are not listed on exchanges. That's what we call over-the-counter. Typically speaking, over-the-counter are less valuable or more risky stocks. So it's investments that are not risky, they're not big enough to be on an exchange. Were they risky investments in The Wolf of Wall Street? Yeah, hell yes they were. So we had people who were basically, let's be honest, guys. If we look at Leo DiCaprio's character in The Wolf of Wall Street, was he an upstanding citizen? No, this guy was out to own a Lamborghini. By the way, the Lamborghini scene is one of the funniest parts of that movie, I think. That movie, if I tried to show that movie in class, I would be fired, I think, before I made it out of the building, because it's just not a movie I can show in class. It's a very racy film. But it's pretty interesting to see how it was in the 80s, because these guys were making money essentially by lying to people. We're going to be getting into, they would tell people these over-the-counter investments were sure things, and they were not. Let's take a look, guys, in terms of a security statement. How do you read this stuff? I got this off of Yahoo. I happen to use Yahoo Finance. Yes, I know I'm a dinosaur, but I like it. I like the way it works. When you get onto Yahoo Finance or whatever aggregator that you're using, here's the information you should be concerned about, guys. You want to know the last time the stock was trading, what did it close at? Oh, it closed at $8.95. Whether it's a stock or whether it's a bond, it's where it closes. What category is this? It's a high-yield bond. Yield, which we're going to cover today, means how much you can expect to make in a year. If you got a 5-year bond, it's going to be, for example, maybe a little higher yield than a 30-year. The 30-year, you've got to hold it to maturity to get the yield. Well, what kind of yield are we getting? On average, we're getting 4.19%, 4.19. That's not huge, but it's not bad for a bond. In terms of the last time this bond paid a dividend, for example, because this is publicly traded, yeah, we paid a 3-cent dividend out. And what about the year-to-date return? Well, so far, this is not doing well. The return on investment for this is a negative 1.17%. And again, we can look at the historical data of this particular security that it bottomed out around the 22nd. Again, I showed you all this stuff when we first got in, but getting into historical data, for example, and performance, these are things that will tell you how the stock has been doing over time, or the bond, or whatever security you're investing in. So, right now, for example, this is trading for $8.95, right alongside its previous close. In fact, when I put this screen cap up, it was October 2nd at 8 in the morning. So trading had not yet begun on that exchange. That's how you read that stuff, guys. Before we continue, because we're going to move through these next slides very, very quickly, I would like to get a question or comment from somebody in the crowd. Yes, sir.
Why was the stuff on Wolf of Wall Street like risky? Wouldn't it be like not risky for them because they knew that they were lying to all the people just to get money?
Well, it wasn't risky. I want to say this very carefully. It's not risky till you get caught. Because basically, here's the deal. If you are playing the stock market, if you're playing the stock market or you're playing with bonds, is any of this a sure thing? No, it's not. There's risk involved. And these guys in the Wolf of Wall Street were basically saying, hey, it's a sure thing. You're going to make money on this really shitty investment, and we're going to give you a great return on investment. And they're making all these promises. I'm going to quote, actually, I won't name the author on this one, but somebody in School of Business who uses this phrase very often. These guys' mouths were writing checks that their asses couldn't cash, meaning they were basically telling the customers they were going to get performance that was not even possible. So if you do that, you run afoul of something called the Securities and Exchange Commission, the SEC. And we're going to talk about how they regulate this kind of trading. So yeah, it was good for them till they got caught. Excellent question. Who else has a question? Anybody? Wow.
How did they get caught? Did they just see how the stock market was like discombobulated or something?
Well, the FBI got involved. So the FBI got involved investigating their finances. By the way, guys, if any of you are interested in working in the FBI, where do they recruit from? What's their number one discipline they recruit? I'll give you a hint. It's within the School of Business, and it's not criminal justice. Good guess. It's a really good guess. Another good one, too. It's accountants. Guys, if you want to catch criminals in 2020, follow the money, you'll find the criminals. And the further part of it is things like forensics and cybersecurity now too, because we're doing all this stuff online. Absolutely. Good questions, guys. Well, we got the bulls versus the bears. And guys, when we say we have a bull market, bulls, of course, charge. They love the color red. So bulls charge bears. The bears are getting ready to hibernate because it's this time of the year here in central Pennsylvania where bears are starting to think about going back to their caves. A bull market means the market is moving. People are buying stocks left and right, and people who believe that a bull market exists believe in optimism. The prices are going up. The market has no signs of stopping. We had a bull market, by the way, guys, from 2009 up until March of this year. And it actually recovered pretty quickly. That was the longest bull market in the history of the country. Crossed 2 presidential administrations and had no signs of stop until COVID-19, but we're still coming back. Bears are people who are saying, we want to be able to make sure we can weather this storm, and a bear market means stock prices are going down. In a bull market, typically speaking, bonds are less attractive. Why is that? If the markets are going crazy with stocks, why are bonds less attractive? Any thoughts? Which is more unpredictable, a stock or a bond? Yeah, stocks are more unpredictable. The market's going crazy, man. Why am I going to settle for this 3 or 4% rate of return when I can get way more if I invest in this crazy market? Here's some money. In a bear market, when the market is not doing well, more people are apt to invest in bonds than stocks. With me so far, guys? We got some key investment concepts. I got to wake you guys up here for a minute. You guys are feeling sleepy this morning. What should we do? What could we possibly do here today? I'm going to sit here in this chair for a second and think about that. Oh, man. I can't believe 5-year-olds are doing better. They're paying this guy to teach this stuff? Oh, man. How is he still here? Guys, my question for you is, what is something that is on your minds right now, other than this class? What is something that has you concerned right now, or something you're excited about or concerned about? I'm going to walk around the room, and we're going to get some conversation going before we get back into these key concepts and give you time to meet with your groups. What's something that's on your mind today? Nothing's on your mind. Okay, what's on your mind today? Oh, who's your team? By the way, in real life, who's your team? Washington. The Washington football team. Excellent. What's on your mind today? Tomorrow, who do you have? Good luck. Good luck. What's on your mind today? So is it cause for celebration or sadness? Celebration. Okay. What's something that's on your mind today? But you made it here. You made it here, man. You made it. Eric, what's something that's on your mind today? Ooh, on top of everything else. Wow. You're going to be in amazing shape here. What's something on your mind today? Oh, me too. I would like to go back to bed too, but it's better being here. What's something on your mind today, sir? Oh, me too, buddy. I can't wait till the election's over. Regardless of the people who are voting for, I just want it to be done. What's something that's on your mind?
First practice today.
What time is practice? 3:30. Good luck. What's something on your mind today? What are you hoping for? You know what? I'd love a Popeye's chicken sandwich right now. Like right now. What's on your mind?
The Bills getting beat last night.
Are you a Bills fan?
Oh, yeah.
Oh, sorry. Yeah. Bills fans, you guys have had to have thick skin over the years.
Yeah, no doubt.
Yeah, absolutely. What's on your mind? Oh, you feeling prepared? Good luck. How do you say good luck in Spanish? Anybody know? All right. See what they say. Graham, what's something that's on your mind today? So what kind of study hours today? You're going to make good use of that time. Nick, what's something on your mind?
Just waking up tomorrow morning.
You're gonna do it, man. I feel it. What's something on your mind today? How old's your friend?
I was at 5:30.
Tell her we said happy birthday. What's something on your mind today? It is cold out there. Absolutely. Okay, you guys are the closer. What's on the smart parts here. You good. What's up? What meeting? Okay. What are you planning on? Okay. What's your friend's name, by the way? All right. Well, our whole class is going to sing happy birthday to her. Will you record it? All right, guys. Kirsten, I want you guys to stare at this camera, and we're going to sing happy birthday to Kirsten. All right? Seriously, go ahead and video record. Stare at the camera, guys. Come on. Come on. I'm serious. She turned 18 today, guys. Come on. I'm going to start it off, all right? So it's 1, 2, 3. Happy birthday to you, dear Kirsten. Happy birthday to you. We're really happy for you. Happy birthday, dear Kirsten. Turn 18. Happy birthday to you, and many more. Thank you, guys. All right, now we're all a little awake. Let's talk about this, guys. These are key investment concepts you got to think about. We all talk about risk, and risk means how risky is this particular investment. If you are putting your money into lower junk bonds, that could be a risky investment, where blue chip stocks maybe not so much. You have to decide how much risk you have a tolerance for. So again, the greater the risk, the greater potential reward. Yield means in a year from this investment, how much can I expect to make? If you got a bond, if you're holding a bond, you're getting regular payments. If you are holding stock, for example, you might get paid dividends. You might get paid revenue from the company, specifically dividends. But what can we expect? You can learn about this by looking at historical data in the particular stock. How long do I have to keep this money invested? Duration. So if I have a 5-year bond, that means I got to keep that money in for 5 years. If it's a 30-year bond, I got to keep my money in for 30. It depends how much of a commitment of time you can tolerate. Liquidity. If I wanted to get my money out of this investment, how quickly could I get it back? If I got Amazon stock, I can sell that pretty quickly. If I have junk bonds, for example, I might have a hard time unloading them. So how liquid is it means how quickly can I turn on the spigot and have it rain money at it. Tax consequences. Again, if you are getting stock benefits, if you're getting stock dividends, you're getting taxed twice on that income as a corporation. So generally speaking, you got to consider, is this worth my investment if I'm going to be paying it all out in taxes? Before we cover regulation, in fact, I think instead of covering regulation, we're going to cover this stuff on Friday, I believe. We're going to break class right now for a minute, because what I would like you to do is assemble into your groups, and before you move, I would like you to do the following. I would like you today to pick between 3 and 4 stocks or bonds, publicly traded, that you want to invest in. Yes, sir?
Do we need to have like the breakup of it yet?
You can still work on that.
Okay.
Yeah, so just pick your 3 to 4 securities. What I'm going to be asking you to do is to email me your stock picks. No fewer than 3, no more than 4. You're going to email them to me, and you're going to carve in all your group members, even the ones who aren't here. You're going to carve in them on your investments. And once you do those 2 things, once you pick your stocks and send them to me and your group members, you're free to go for the day, knowing that we're going to cover the rest of this stuff on Friday on our online Friday. So gather into your groups, guys. I'll be around to check on you.